Good afternoon, everyone. I'm Inki Cho, Senior Financial Market Strategist at Exness, and this is your weekly market outlook for April 2nd, 2025. Market sentiment has been shaken by renewed tariff threats from the Trump administration. Early last week, President Trump appeared to take a softer stance on tariffs, which helped calm market volatility. But just as markets started to stabilize, he surprised everyone by slapping a 25% tariff on imported cars, marking the official kickoff of a more aggressive tariff policy. According to Goldman Sachs, about 50% of the 16 million cars sold annually in the US are assembled domestically, with 40 to 50% of their parts sourced from the US. That means if the new tariffs are enforced, imported cars could face an extra cost of up to $15,000 per vehicle. Even US assembled car could see price hikes of up to $8,000, assuming they use 50% of imported parts. Naturally, this would fuel inflationary pressure across the economy. And this price shock could trigger a broader slowdown in the auto sector. Higher car prices would likely drag down demand and sales volume. And we are already seeing signs of this. Ferrari, for example, announced right after the tariff news that it would raise prices by 10% across, across most of its lineup. These inflation concerns are also showing up the actual data. The February PCE, Personal Consumption Expenditure Index, came in with a headline reading of 2.5%, in line with market expectations. But the core PCE, which strips out food and energy, rose 0.4% monthly and above both the previous reading and the market consensus of 0.3%. On a 6-month annualized basis, core PCE is now at 3.1%, and the 3-month figure is running even hotter at 3.5%. Clearly, inflation is not only above the Fed's 2% target, it's actually accelerating. More signs of pressure came from the latest Conference Board consumer confidence data. In March, the index dropped sharply to 92.9 from 100.1 in February, recording its lowest reading in nearly 4 years and below the consensus forecast of 93.5. The expectations components took a tough hit, falling by almost 10 points to 65.2. Meanwhile, inflation expectations for the next 12 months surged to 5.1%, the highest level since May 2023. That jump reflects growing consumer concerns about how Trump's tariffs could feed into the inflation. Stagflation fears are also starting to creep in. The University of Michigan's March Consumer Sentiment Index fell to 57, down from 57.9 the previous month. That's the lowest reading since late 2022 and marks a more than 30% drop since November. The share of respondents expecting unemployment to rise over the next year is now the highest since 2009. 1 year and 5 year inflation expectations also moved higher to 5% and 4.1% respectively. Notably, that 5 year figure is the highest in 32 years, a clear signal that long term inflation fears are taking hold. Against this backdrop, markets are slashing their US GDP forecast. The Atlanta Fed cut its first quarter GDP estimate from minus 1.8% to minus 2.8%, citing concerns over weakening consumer spending and persistent inflationary pressures. Even Goldman Sachs, which had been relatively optimistic, has revised its outlook. The firm now expects US GDP growth of just 1% this year, down from 1.5%. It also says the PCE inflation rate rising to 3.5% and projects the unemployment rate will climb to 4.5 by year end. As a result, Goldman Sachs has raised its estimate for the probability of a US recession within the next year from 20% to 35%. We are also seeing early signs that the once booming US labor market may be cooling down. The latest JOLTS data from the Labor Department shows job openings fell by 200,000 from the previous month. The number of job openings per unemployed person dropped to 1.07, recording its lowest level since September last year, suggesting companies are starting to slow down their hiring. Manufacturing data is flashing warning signs too. The ISM manufacturing PMI for March dropped to 49, indicating contraction after 3 months of expansion. New orders fell to their lowest level since May 2023, while both production and employment components also declined. On the other hand, the paid price index jumped to 69.4 from 62.4, recording its highest reading since June 2022, adding to inflation worries. Tomorrow could be a pivotal day as we will likely get more clarity on the direction of Trump's tariff policy. With every comment from the president capable of sparking major markets move, it's important to stay sharp, review the data, and trade wisely. This is the end of the market outlook for the 2nd of April 2025. I'm Inki Cho, the Senior Financial Market Strategist at Exness.